The volatility party, people, it's just getting started. We're going to talk about that on today's stock market brief, going over some key levels to be watching when Fed Powell takes the stage. Now, we had inflation data come out today, and it came in cooler than expected. And, if it comes in cooler than expected, the market said yahoo to that. However, the big thing is going to be this Fed meeting. And then don't forget, we also have an OPEX, a big option expiration on Friday. So is the Fed going to come out and be hawkish per their current story, or are they going to come beat the bears up and start to see a continued stock market rally? After getting the CPI print, it looks like we will be intact for getting that 50 basis point hike. That's the probability going into tomorrow. The big change was February, how February now looks like it's going to be a higher probability of a 25 basis point hike rather than a 50 basis point hike. What else took place? The dollar was pretty much the only thing red on the screen out of the gate, and then everything else was up. But if you take a look at the 11 sectors, right, everything was pretty much in the green other than consumer staples. Consumer discretionary, right, was flat, but everything was mute for the most part. And that's because, well, when the report came out, we saw this massive move to the upside, right around those expected moves that we discussed on yesterday's brief. And you can see it sold off for the remainder of the day. And I personally do not think many people were to take this type of bet, thinking that, hey, if it goes up, maybe you'd want to buy the dip to see if you can catch the rip and it continue up. Because a lot of these face ripping rallies or squeeze days, you typically get the market to just go straight up and close at the high. But you can see here, if you just go from where the where the CPI print came out, we closed basically on the nose right there. So really, we erased all the gains from that CPI print. Now, if we take a look here at the expected move, we came outside of the expected move. We got above the 200-day, and then you can see we closed back beneath it, but we're still above that 20-day. Now, I want you to pay attention to this lower level here, because we're going to talk about the volatility party, right? It's just getting started. Well, 3850 is an interesting level because I'm pulling up Bookmap, and I did see that throughout the day and even prior days, there has been a lot of liquidity down here at that 3850 level. So that is going to be a level to very closely keep an eye on if the market wants to continue to sell off. If you guys aren't familiar with Bookmap, I know it looks confusing and stuff, but if you day trade or you're looking at order flow, like level 2s, this paints this on the screen. I have a link in the pinned comment so you can learn about it if you want. On the top side of that, 4125 and then 4162, there's some areas of higher liquidity there too as well. So continue to watch those levels going into tomorrow. Now, overall, if we take a step back and look at the weekly timeframes, there is some interesting data here on the 50-period weekly moving averages. You can see here that we came in, we tapped it, and then we started to sell off from that level. So if you want to be more bullish, I would say that would be a level that you'd want to see overtaken from a weekly perspective. And as it stands right now, the bears are holding that fort. If you take a look at the Qs are right there around the 20 weekly moving average. The 50 is still declining. We haven't tested that, and you can see the 200 weekly moving average is still holding. You can see, though, they are compressing. They're getting tighter, which means what? It means that we could see an explosive move here in the near future. Now, if you take a look at IWM, look how tight this is getting. So price action, right? The price action's been 1, 2, 3, 4, 5, 6, 7, 7, 8 weeks of pure sideways price action. The moving averages are getting very, very close together. So remember, contraction leads to expansion. Expansion leads to contraction. Right now we're contracting. So can we see an explosive move back down to test this 160, potentially break it? Or will the bulls take over and we start breaking above this 50-week moving average? You can see it's held as an area of resistance here. It held it as resistance here, and then it's been holding as resistance for 1, 2, 3, 4 separate occasions on the week. So 4 separate weekly occasions, I should say. And if you take a look here at the summation index, we still have that potential change in trend that took place. We had the parabolic SAR that's uptick through that summation, despite even seeing the bullish start to today's price action. Same thing goes with the NYSE summation, which is a broader market there. All right, let's go ahead now and take a look at the 15-minute time frame to get a really clear idea as to what may take place in not only tomorrow, but the remainder of the trading week. So first and foremost, yesterday's closing day, we closed right at that month-to-date anchored VWAP, and then we opened way up here on the report. So we anchored a VWAP over to here on this day too as well, and you can see that we never really broke back above it. So from the bulls perspective, you want to see price get back above here and this start to turn back up. And that would be in my opinion, more of a bullish sign, something like that, if you are a bull. Now, if you are more bearish, I would say be very aware of this month-to-date anchored VWAP, because if the bears take hold of this, it could potentially then act as a level of resistance where you can see something like that take place. So as it stands right now, the month-to-date anchored VWAP, very important to watch. It's still holding that level. And then we are below the CPI print anchored VWAP here too as well. I will note that we are above the 5-day moving average, but it is rather neutral at this point, kind of going sideways. Now, this is where it gets absolutely crazy, people. Tomorrow's trading session, we're looking at a plus or minus $7.1 move, which is roughly a $71 move on the SPX. Okay, so this is interesting to me because you got to understand, last week we had basically a $70 expected move for the entire week. Coming into tomorrow's trading session, we're looking at a huge area of volatility. So when Jerome Powell comes out, be aware of these levels up here, plus or minus 7 where we've previously closed, because that is more than possible. And we've been seeing 2 sigma moves, all right? Now, this is where it gets even crazier, is the remainder of the week we're looking at a $10 expected move. So we have, less of the trading week left, and yet it's, almost double the size, not quite, but it's almost double the size of last week's expected move for just a few trading sessions. So this is what I mean by the volatility party here. People is just getting started. So do not, take very directional type of risk, because the unfortunate thing is the market can go either way. It's a very binary thing. So when Powell comes out, right, they raise rates. If he's very hawkish, the market might see that as bearish, and we might start heading back down. But if the market interprets it as, hey, he's kind of saying some dovish terms, we can skyrocket right back up to this weekly expected move and potentially outside of it. But like I said, the key levels to watch are going to be the month-to-date anchored VWAP, and then also this anchored VWAP right up here from the CPI print. So if we start breaking either direction, those will be some key levels to watch to see if we get some continuation. If we take a look at the Qs, we're looking at a $6.3 plus or minus expected move. I will note that you can kind of call this a bear flag, but as it stands right now, I'm not too fond of the market structure. Like, yeah, we could break down, boom, and there's your bear flag breakdown. It's more than possible, but you got to understand that Powell can take this thing. As soon as he starts talking, as soon as he comes out, there's just going to be a lot of volatility, and the one way to handle volatility is to, one, start backing off your exposure into the markets. Like today, right, we moved way up and then we sold off for the remainder of the day, and basically wiped out all those gains. And what does that mean? Well, I mean, if you FOMO'd up in here, you got completely wiped all throughout the day. And, one way to mitigate that is to just let the market digest the information and then approach it from a tactical perspective. That's what I plan to do. That's what I did today. Now, another thing that I want to kind of focus in on is the month. We're looking at a 1 month performance of the S&P 500, 11 sectors. And you can see the top 3 right here. You can clearly see we are in a defensive stance. So we have healthcare, utilities, and consumer staples. So as it stands right now, the market does seem to be positioning itself for risk off type behavior. Now, if I go even further though, you can see the zones. You can see HYG, which is high yield. It is at that higher end of the range. So if this starts backing off, it does have a strong correlation with the S&P 500. And I will note too that you're starting to see like utilities start to reach that higher end there too as well. You have semiconductors, which took a big move up today, but then started selling off like a majority of those assets, and then Bitcoin too. And then also we talked about gold and silver. Those went up today, but they are nearing their higher ends of the ranges. So people, be prepared. There's a lot of volatility coming into the markets tomorrow and for the remainder of the week. These are the levels to watch. These are the ranges. This range is right here, like I said, for tomorrow, and this range is for the remainder of the week. But come on after business close tomorrow, we'll update this to see what has changed. That's all I got. See you later.